I'm Dylan Radigan. I've interviewed nearly every CEO and most world leaders during the past 25 years. And now I'm bootstrapping. I'm turning my attention to the new CEOs and the irrepressible entrepreneurs leading the next generation of innovation in the world. Welcome back to Tasty Live. I am Dylan Radigan. Time for another episode of Bootstrapping. Our guest today, Chuck Pettit, his company Republic. And what a company it is, Chuck. I'm reading. I mean, listen, the email I have here, this sounds like, this is a real thing.
We're trying. It's been a 7-year battle, but we were starting to make some noise finally.
7-year battle. So let's talk about Republic. It's a global securities marketplace, digital merchant bank, and investment infrastructure firm enabling 3 million plus retail investors access to private markets.
That's correct. So we've helped over 1,500 companies raise about $2.5 billion, mostly from the retail investor. We are global, North America and Europe and Asia. We've been in business now for about 7 years and have made some iterations and adjustments along the way, but originally started as a company focused solely on investment crowdfunding, quickly added a crypto arm and then a venture capital arm to boot. So we've come a long way and have started to formulate a pretty good financial technology firm.
So let's talk about this a little bit. Let's talk about some of the hard parts of something like this. I have two specific parts that I want to discuss with you. One is what I'll call the filter, or the top of the funnel, how you get your first batch of even deals to sift through. And how you because that's the, I'm curious how you run your filter to even figure out where to pay attention, where do I spend my time, and resources.
Yep.
I'm interested in how you make that decision. And then I'm also interested in how you facilitate the liquidity for the retail investor. Is there a secondary market? What's the nature of the participation? What's the retail investor's relationship? And what's the filter for the entrepreneur? Both very interesting.
Got it. So in 2016, we launched on the heels of the 2012 Jobs Act, the part of it that became effective in May of 2016 for regulation crowdfunding.
I remember this legislation well. But remind everybody what this created a specific opportunity.
A specific opportunity for non-accredited investors to participate in private company opportunities. Previously, you had to be an accredited investor to make an investment in a private company. Otherwise, you were only going to invest in publicly traded stocks and bonds. We launched on that law, and there was zero product market fit, both on the issuer side, the company side, the founder side, and the investor side. So we were scratching and clawing to get anyone to move forward. We launched with four companies only, right? I mentioned the number over 1,500 since. So 4 companies came out of the gates with us in 2016 that summer.
And they were, you saying 4, you had 4 that were good enough to close a sale, you're saying, to close a transaction.
We closed the sale on 4 to move forward with a public campaign that people could invest from, regardless of their wealth and basically anywhere in the world from. And it was a battle, but we did get these companies across the finish line. They ended up being things that people could point their fingers at and say, hey, if they can do it, we can also do it. And if they can do it that well, we can do it better because we're a better company than they are. Founders typically have that mentality. And the snowball effect really began late 2016, which led to, and you got to imagine too, we're only 4 or 5 people at the time. We're all wearing 20, 30, 40 different hats. And you had to be nimble in navigating the chaos to make it successful.
You guys are doing this from New York at this point? This is all happening?
This is all happening from New York. We specifically didn't want to be in San Francisco. We felt New York is the financial capital of the world, and that's where we should be. Granted, we were working with a lot of Silicon Valley companies. They were looking to us to help them raise capital, but we wanted to be in New York 100%. And so yeah, it was, like I said, a bit of a battle.
So now talk to me about just in the interest of time, because hopefully we'll be able to have this conversation over multiple interviews. But set aside the filter for a second, which is you had enough success early to turn on a magnetron, then you had inbound. And then you had a better choice.
And then we had a better choice, which is a better opportunity for the crowd investor at the end of the day also.
Yeah.
So, it's taking
but that
years
still
for us to
doesn't
get to a point.
But how did you get it? How did you create a syndicate? You're telling me you're a capital market. You're telling me you have the trust of the marketplace that if I prepare my company's, whatever it is, securities offering ultimately with it on your platform, that it's good for my company for some reason, part of which is the investors are going to buy it.
Exactly. So we created a bit of a one-stop shop for companies. They could come into us and raise from the crowd. They could go to our capital arm and they could raise from institutional investors. We also created funds that we could make direct investments into those same companies. So a lot of times they would come into us at an earlier stage in their life cycle. It would take 3-6 months to do the crowd part. They go off and do their thing for another 6 months. They'll come back to us and say, hey, we're up for institutional capital at this point. We want to raise 25 million. So that's why we had the capital arm. And they went through a bit of a learning curve too, where we were helping companies raise 250, 500K, and then it went to 5 million, it went to 25 million. It was 50 million per launch that we did with our capital arm. And that was coming from high net worth and family offices and some smaller venture capital funds that couldn't get access to the deals that we were getting. We had a core of team members that were from the Silicon Valley scene, and they were getting high quality deals. But without there being product market fit for the time being, in 2016, 17, 18 especially, we couldn't put them into the crowd. They weren't doing those things, but They would take money from capital. They would take money from our funds. So you started to build these different networks of relationships, and people had like a good vibe about what Republic was doing. And that eventually started to work once there was better product market fit. More people pointing more fingers at others.
Then you think radiates, activates back down to the crowd ultimately, just off of it's like a bank.
It does, and now we finally see it going both ways. So sometimes people come into the capital part of our business first, and then they end up in the crowd, or vice versa. And it's a bit of a graduation level, but also just a bit of a networking effect.
So what is the business today?
The business today is a global securities marketplace serving the retail public and a digital merchant bank serving enterprises. The global securities marketplace is better known as investment crowdfunding, and the digital merchant bank is a seed to liquidity play in the blockchain space. So we take companies and we'll help them with their initial idea to deploy blockchain across an asset or their entire company. We'll help seed that with capital from our private capital division. We'll even raise capital from the crowd through the securities marketplace. We'll help them with exchange listing services. And then finally, we do staking services for the institutional investors. Soon, in the next, say, 90 days, tops, we'll be able to do that for the retail investor as well through our wallet. Those companies in the digital side of the business typically are well established. They've been around for a long time. They've raised serious capital, make serious money, et cetera. And they're looking to start something new within the blockchain space. Or on the securities marketplace, you typically see like your standard startups, early, middle, late stage.
Just for purposes of, because it's a lot, but just for purposes of compartmentalization, what is the typical dollar value of the typical raise of the typical Republic company on the crowd?
On the crowd, so that averages about $650,000 raise.
And is that a tight average, or is that all over the place? Is that from 50 grand to 5 million, or is that from 400 grand to 700 grand?
So 50 grand to 75 million from the crowd. It depends on which securities exemption is used. So if it's Reg CF up to 5 million, Reg A plus up to 75 million. We've had campaigns who've done Reg A plus who've raised 30, 50, and 75 million, and we've had dozens of CF campaigns that have raised $1 to $5 million.
And have had companies repeatedly tap the crowd more than once over a progression, or go from the crowd into the platform, like stay inside the system?
In North America, not so much. In Europe, definitely. In Europe, you'll see companies come back 3, 5, even 7 times or more to raise from the crowd. It's a little bit more accepted there than it is here. Better product market fit in the European and investor world.
You're saying the social culture in Europe is at ease. They're like, of course, another round for whoever, for whatever, we'll run it around. In America,
that's simply from having like a 3-year head start on the US markets.
Okay. It's because London's the fintech capital of the world, going back a few minutes or so, they would tell you.
Well, and I don't disbelieve that. That's part of the reason why we acquired a London-based investment crowdfunding platform last year.
Yeah. And my experience would reflect validity to their claim. Do you ultimately believe, just to wrap up this particular conversation, do you believe that the intention of the was it the Jobs Act or the Stock Act?
Yeah.
Do you believe that the best intentions of that legislation, when it was brought into effect, have been manifest in the decades since? And if you were to amend it in any way to the benefit of the entrepreneur and the small investor, what would you do?
They have, from the aspect of quality. The Jobs Act is finally starting to see companies who are of high quality utilize it, which is one of the primary reasons why they wanted to have it happen in the first place. What it is missing to date is true return on investment to those investors. Mm-hmm. We have returned about $200 million to investors since inception. It needs to be significantly more.
Well, what is it? Forget the dollar value. What's the percentages? Like, how are the numbers? Is it a break even or not even break even? Is it 5%, 10%, 20%, unknowable, blah, 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 blah? Like, because like, for instance, with the green infrastructure, they spent a fortune and paid nothing. Like billions of dollars, paid zero. But it was I'm
not sure you can quantify it. I mean, north of 80% of the companies that we work with are still alive. They haven't failed. And that's not an insignificant number in the private market. So that's a good thing, but they still haven't actually exited or returned capital to investors.
So the return is on TBD is the answer to the question.
100%. And I'm excluding, a lot of REITs will utilize Regulation A+, so yes, they are returning interest and dividends to their investors. We have revenue share deals. We have other debt deals that pay back investors their capital. That is a smaller part of the market today, but as more and more,
that's interesting though, because as you know, the private equity cycle or whatever, let's say it's 7 years, right, for a fund cycle to pay, right? If you were to assign a cycle to crowdsourced equity, private companies, which is another private equity in its own way, right? It's a private company at the very least. Is it a 10-year cycle, you think? Like if you and I had
a fund, at least 10. Yeah. It's at least 10. I mean, when I was doing this, just angel investing in the early 2000s, it was something like 5, it felt like. And now today it's closer to 10 for sure. Companies are staying private longer than ever before.
Yeah.
And that's part of the reason why we're actually focused so much on having a proper secondary market with proper liquidity behind it. So our European operation actually has the largest secondary market in the world, the most active secondary market in the private space. Yeah. Our North American product is just under beta mode today, and that will be for standard traditional financed securities. And then we are also launching a digital secondary platform.
It must be pretty crappy markets, with all due respect, just because.
Yeah. Those are also very difficult to bring to the market, so we're utilizing that time that we have with the SEC.
No, I mean any market is better than no market. I'm not breaking your chops here. I'm just saying everybody knows that markets like that are not necessarily that deep, or certainly not that deep at that price, whatever they may be.
Yeah.
But still, that's pretty amazing that you're generating secondary liquidity at all is remarkable to me, actually. Is that because of crypto allows you that? How is that happening?
Well, we definitely think crypto will make it certainly a lot easier and more organized and easier to track, and for payments both ways. But it's just there's an appetite for it in Europe, honestly. And again, that goes back to them having a 3-year head start on the North American markets,
which then must come back to your UI.
It does. It comes back to our user interface, or
your user is what's on the phone for those Europeans matters. Which can I pick? What can I do? I mean, that's my assumption.
Well, I think that one's actually built up around a little bit of FOMO, because it only opens up once every month or so, and it's only open for a few days at a time. So we're garnering interest from both buyers and sellers and tell them this is when it's going to be open. You get a reminder that it's open, today at 12 o'clock, and you also get a reminder that's closed on Thursday at 12 o'clock. So you have a limited time to act, both on the buy or the sell side, and people do act within that time frame.
Phenomenal. Cool stuff. Well, I appreciate your taking the time to share not just with me, but with everybody at Tasty, what you guys have been doing. Yeah, I think that certainly, I think we've had a couple of your enterprise companies as guests. I think Jules, who's our producer, has booked at least one of your enterprise companies as guests. And if I remember,
Yeah, Jay Bang on.
yeah. And then he told me that somebody at your company liked the idea of having these entrepreneurs come on this program, but that I was encouraged to have a stronger opinion about the pitch men and women as they show up.
That was me, and I agree. The biggest problem in our industry today on the securities marketplace is that there is no advisory. We are not allowed to under the laws that we work under. We could do it through one of our RIAs or through our broker dealer, but it just becomes like a regulated, complicated mess. We believe television is a great way to get it across to the retail investor, and it's a great way for them to be educated and to be given proper professional guidance in a legal, compliant way. Mm-hmm. We had a television show with Tim Draper for 4 years that was the first of its kind. We went through hell and back with the SEC on it. We learned a lot of stuff, and I think it's just, it's the right time because we have better product market fit today because we know what we're doing, and we have better pipes for it internally, infrastructure-wise, to be public to run these type things. To go for it in a promising way that's actually beneficial to the retail investor. And that's why I have conversations on a daily basis with the Morgan Stanleys and the Charles Schwabs and the Fidelities of the world. And they're all circling, looking at us and saying, they know that advisory is missing. They know they can bring it to their clients. And they know they're going to have to soon because of the demand they're getting from their private wealth group clients. But what they want to all do is go the accredited investor route only because they perceive it as being less risky for them.
Sure.
And I'm about getting it to the actual, true retail investor who's going to put $50 or $500 into a deal. They need proper advice too.
Right.
And that's what we're trying to provide, through something like this.
Cool. We'll talk much more about that. I'm hoping. Chuck Pettit, EVP over at Republic, and my new friend in New York. You're watching Bootstrapping on Tasty Live. We're back after this.